Welcome back to the Grow with Tony podcast, the space where we deconstruct the complex world of finance and reconstruct it into a life blueprint that actually makes sense for you. I'm your host, Tony. Today, we are diving deep into one of the most polarizing debates in the investing world. It's a battle between the desire for explosive, life-changing wealth and the need for steady, unbreakable financial security. Imagine you are standing at the edge of a vast ocean. You have to cross it to get to the island of financial freedom. You have two boats to choose from. Boat number one is a high-speed racing boat. It's sleek, it's fast, and if you know how to handle it, you'll get to the island in record time. But if you hit a rogue wave or if the engine stalls, you could capsize instantly. Boat number two is a massive, slow-moving cargo ship. It's not winning any races. It's boring, it's heavy, but it is built to withstand hurricanes. It moves forward inch by inch, mile by mile, regardless of the weather. This is the choice you face when you decide to start dollar-cost averaging. Do you take the racing boat, DCAing into individual stocks like Tesla, Apple, or Nvidia, or do you board the cargo ship, DCAing into ETFs like the S&P 500 or the Nasdaq? Which one actually makes you rich? Which one protects your sanity? And honestly, which one is built for you? We are going to break this down layer by layer. Just a quick disclaimer before we dive in. Nothing in this episode is financial advice. I am just a guy sharing perspectives, so always do your own research. Now let's begin at the foundation. We need to truly understand the mechanism of dollar-cost averaging, or DCA. Most people think DCA is just investing monthly. But it is much more psychological than that. DCA is the antidote to market timing. It is the admission that we, as human beings, are terrible at predicting the future. We don't know if the market will crash tomorrow or soar to new highs. By investing a fixed amount of money at regular intervals, say on the first of every month, you are mathematically hacking the system. When prices are high, your fixed amount buys fewer shares. You are cautious without trying to be. When prices crash and everyone else is panicking, your fixed amount buys more shares. You are aggressive when it matters most. You lower your average cost per share over time. It is elegant in its simplicity. But here is where the path splits. The strategy is sound, but the asset you apply it to changes the entire game. Let's talk about path number one, dollar cost averaging into individual stocks. This is the path of the stock picker. It's the path that promises the Ferrari. It's the path of high conviction. The argument for this is seductive. If you had decod into Amazon starting in 1997 or Apple in 2005 or Bitcoin in 2015, you wouldn't just be comfortable today. You would be a dynasty. You would have generational wealth. When you buy a stock, you are buying a piece of a specific business. You are betting on a specific CEO, a specific product, and a specific vision. If that vision succeeds, you capture 100% of the upside. You don't have to share the glory with 499 other mediocre companies. Think about the math. If a stock goes up 10,000%, which is a 100 bagger, and it makes up a large portion of your portfolio, your life changes overnight. An ETF, by definition, is diluted. Even if the top company in an ETF doubles, the ETF itself might only go up a few percent. So for the pure adrenaline of maximizing returns, individual stocks are the undisputed king. But, and this is a massive but, we have to talk about the idiosyncratic risk. That is a fancy finance term for single point of failure. When you DCA into a single stock, you are not just betting on the market, you are betting against disaster. Let's look at a painful example. Let's talk about a company like PayPal or Alibaba in recent years, or go back further to General Electric. These were titans, blue-chip companies. People thought they were safe. If you had blindly decod into these companies during their downtrends, you weren't building wealth, you were burning cash. There's a saying in trading, don't catch a falling knife. When a single company starts to fail, whether it's due to fraud, bad management, or simply a change in technology, it can go to zero. Stocks can and do go to zero. If you're DCAing into a losing stock, the math works against you. If a stock drops 50%, you need a 100% gain just to get back to where you started. If it drops 90%, you need a 900% gain just to break even, meaning your remaining $10 must grow to $100, a 9x increase. Furthermore, managing a portfolio of individual stocks is not a passive activity. It is a part-time job. You need to read quarterly earnings reports. You need to listen to the CEO's guidance. You need to understand the balance sheet. You need to watch the competitors. If you are blindly buying a stock just because you like the product, you aren't investing. You are gambling with a systematic plan. Now let's pivot to path number two, dollar cost averaging into ETFs. This is the path of the wealth builder. It is the path of the cargo ship. An ETF or exchange-traded fund is essentially a basket. When you buy the S&P 500, you are buying the 500 largest, most profitable publicly traded companies in the United States. You are buying Apple, Microsoft, Google, Amazon, Berkshire Hathaway, JP Morgan, and hundreds more, all in one click. The beauty of the ETF is not just diversification, it is self-cleansing. This is a concept many people miss. The S&P 500 is survival of the fittest. If a company starts to fail, let's say like Kodak or Blockbuster did, it eventually gets kicked out of the index. It is replaced by a new, growing company like a Tesla or a Netflix. You don't have to sell the losers and find the winners. The index does it for you, systematically through quarterly rebalancing based on market cap criteria and committee decisions. You are always invested in the winners because the winners naturally rise to the top of the index while the losers fade away into obscurity. The pro here is peace of mind. You eliminate single company risk. If Apple has a bad year but the energy sector has a great year, your portfolio is balanced. You are betting on the entire economy, not just one player in it. The con, you cap your upside. You will never get a 10,000% return in a few years with a broad market ETF. You are accepting the average return of the market, but historically that average is about 8 to 10% per year over the long run. And thanks to the magic of compound interest, 10% per year makes you a millionaire. It just takes a little longer. Let's delve into the psychology of these two approaches, because this is where most investors fail. Volatility is the price of admission for high returns, but most people underestimate how painful volatility actually is. Let's look at a real-world comparison, Tesla versus the Nasdaq 100. Tesla is a masterpiece of innovation, but as a stock, it is a roller coaster from hell. There have been periods where Tesla has dropped 60 or 70%. Imagine you have been DCAing for 3 years, you have saved $50,000 of your hard-earned money. Suddenly, bad news hits. Elon Musk tweets something controversial. A recall happens. Your $50,000 turns into $25,000 in 3 months. Can you sleep at night? Can you look at your family and say, it's going to be okay? And most importantly, can you continue to buy more? Most people cannot. When the pain gets too high, they sell, they capitulate, they lock in the loss. Now compare that to the Nasdaq 100 ETF like QQQ. It also drops. Tech is volatile, but when the Nasdaq drops 30%, you don't think, is the Nasdaq going to zero? You know it won't. You know that for the Nasdaq to go to zero, Google, Apple, Microsoft, and Meta all have to go bankrupt simultaneously. If that happens, money is the least of our problems. We are probably fighting for canned food in a bunker. Because you have confidence that the ETF will recover, you are actually excited to buy the dip. You stick to the plan, and because you stick to the plan, you actually make money. There's a concept called survivorship bias. We look at the past and say, if I had bought Apple, I'd be rich. But we forget about the thousands of companies that looked just as promising as Apple in the 90s but went bankrupt. We forget about WorldCom. We forget about Lehman Brothers. When you choose individual stocks, you have to be right twice. You have to pick the right company and you have to hold it for the right amount of time. When you choose ETFs, you only have to be right about one thing, that the global economy will continue to grow and innovate over time. That is a much safer bet. So let's talk about time. Time is the only asset you can't buy back. DCAing into stocks requires time. You need to analyze valuation. Is the PE ratio too high? Is the debt manageable? Is the moat strong? If you aren't doing this work, you are flying blind. DCAing into ETFs gives you your time back. You set up an automatic transfer. You buy the world. You go play with your kids. You focus on your career. You build a business. You sleep. The ETF works while you rest. So the ultimate question, which one makes you rich? The answer depends on your definition of rich. If rich means hitting a jackpot, buying a yacht next year and retiring at 30, then you have to play the stock picking game. But understand that you are playing a game with high failure rates. For every Warren Buffett, there are 1 million investors who underperformed the market. If rich means having $5 million in the bank by the time you are 50, never worrying about bills and having absolute freedom, then ETFs are the guaranteed path. It is the get rich slowly scheme that actually works. But is there a middle ground? Can we have the best of both worlds? Absolutely, I call it the core and satellite approach. Imagine your portfolio is a solar system. The sun, the massive center of gravity, should be your ETFs. Maybe 80% to 90% of your money goes into a low-cost, broad market index fund. This is your safety net. This guarantees your retirement. Then you have the satellites, the small planets orbiting the sun. This is the remaining 10% or 20% of your money. This is your fun money. You use this to DCA into those high-conviction individual stocks. You buy the companies you love. You scratch that itch to be a stock picker. If those stocks go to the moon, fantastic, you speed up your retirement. If those stocks go to zero, it hurts, but it doesn't kill you. Your core, your 90%, is still compounding away safely. This approach satisfies both the mathematician in your brain who wants safety and the gambler in your heart who wants action. Now I want to address the listener who is sitting there thinking, Tony, I'm young, I can take the risk, I'm going all in on stocks. I admire the courage, but remember, discipline is easy when the market is going up. Everyone is a genius in a bull market. The true test of your DCA strategy happens in the bear market. It happens during the recession. It happens when your portfolio is in the red for 2 years straight. If you are 100% in individual stocks, the psychological pressure during a crash is unbearable for 99% of people. But if you are in ETFs, you just keep buying. You know that every recession in history has been followed by a recovery. So to wrap this up, let's crystallize what we have learned today. We learned that DCA is a powerful tool, but it amplifies the quality of the asset you choose. DCAing into a bad asset just makes you lose money faster. We learned that individual stocks offer uncapped potential but come with the risk of total loss and require significant time and emotional control. We learned that ETFs offer the power of self-cleansing and diversification, protecting you from your own bad decisions and ensuring you capture the market's long-term growth. And we discussed the hybrid approach, core and satellite, which might just be the perfect balance for those who want a little bit of excitement without betting the farm. Ultimately, wealth isn't just about the numbers on the screen. It is about the life those numbers allow you to live. If your investment strategy keeps you up at night, it is the wrong strategy, no matter how high the returns are. The best strategy is the one that allows you to stay the course for decades. I hope this episode gave you some clarity on your journey. If you got value from this deep dive, please do me a massive favor. Smash that like button, hit subscribe, and ring that notification bell so you don't miss our next masterclass. And I want to hear from you. Drop a comment below. Are you team ETF, team stock picker, or a hybrid? And tell me, what topic do you want me to cover next? I read every single comment and I build this show for you. Thank you for spending your valuable time with me today. Keep compounding, keep learning, and I'll see you in the next one.